I'm Catherine Ross, and I'm here live from the NYSE with Jim Cramer. Jim, this morning on Real Money, you wrote about oil. You outlined that oil hasn't quite recovered from where it used to be. And I'm wondering, what is it going to take to make oil investable again?
Well, certainly not the a flagged British tanker with 2 million barrels being pulled over by a couple of speedboats. That did not do anything. What is going to take it is worldwide growth. Worldwide growth has to increase, which means the tariffs have to be scaled back and a deal with China. If you get that, then oil can go up, and then the oil stocks will go up. Halliburton, good quarter this morning. I have to incorporate that into my real money piece. But it's really important to recognize this is just worldwide growth. It's a proxy. And the companies that are domestic are just really being hurt. They're not, they have a lot of problems. Every time they drill, they have natural gas. They don't even know where to put it. Ours is an abundance. Overabundance of oil has really kept the lid on oil. And unless we get worldwide growth, you're going to see continually weak numbers.
Real money stock of the day is Disney today. They released The Lion King. It grossed $185 million in its opening weekend.
Yeah, this is the beginning of domination in terms of Disney weekends. If Disney has a weekend that they're going to drop something, then everyone else steps aside. So whenever Disney doesn't have something good, they can go to the fore. But if Disney could release something every 38 weeks, a year, then you'll see these kinds of numbers because the competition just isn't there, except for on a periodic basis. So at a certain point, what you're going to be able to do is actually build a number based on film. It's never been that way. People have always been suspicious of the film earning stream. And that's no longer the case. So then if you get that going and people recognize it's not episodic, next thing you know what's going to happen, Catherine, is you're going to have people saying, you know what, I think that we're just looking at Disney Plus. If Disney Plus is good, then the stock can go to 160. If Disney Plus is on hold, we've been saying we have a very good note that's coming out, it can go to the 130s.
So is Lion King enough to sate investors' appetite as they wait for Disney Plus?
Well, I think that Lion King is more of a metaphor for the time. I mean, here's a movie that got bad reviews and it did well. There was another time when a movie would get bad reviews and the stock would go down. That's no longer the case. There's just kind of a built-in group of people, coupled with the fact that the competition is so lame. So a hot weekend to itself, Disney, with a film that is criticized, shows you the power of this franchise. So I think, look, we were discussing this morning whether to trim Disney because we have such a big gain. And instead, what we decided to do is if it goes down, we will tell people to buy it.
All right, Jim, let's talk about another company that also has
I'm sorry, go ahead.
Let's talk about another company that also has a streaming service that is in the works, and that's Apple. Now, Apple this morning got two dueling notes, one from Morgan Stanley's Katie Huberty and another one from Bernstein's Tony Sacconaghi. Now,
shows you we're in a glass half full environment. Tony's a very rigorous analyst, and he's losing out right now to Katie Huberty in terms of the idea that maybe the service revenue stream is positive. And, Tony's talking about how the setup is not good, and Katie meaning that the stock's too high. And Katie Huberty's talking about the setup being good in terms of the earnings too low, the earnings estimates. So this is something we're going to have to talk about in our next video for club members because it may be a determinant of what happens for the rest of the day. I mean, Apple's the leader today, and I don't know if it should be.
I'm glad that you bring that up. So we are going to talk about this more on Action Alerts Plus over on our daily rundown show over on actionalertsplus.com. But Jim, I want to take a step back from Apple specifically, and I want to ask you an investing education question, circling around the fact that when two prominent analysts come out with dueling notes, if I'm an investor and I'm a little confused as to who I should believe in, what's my first piece of homework? Your
first piece of homework would be check on the track record. Katie Huberty's track record is very superior to Tony's. Now, Tony has always been, we could say, well, listen, I've liked it the whole way, but no, he's kept you out of it, and she's kept you in it. But she hasn't distinguished herself this go-around in that when the stock was down a lot, I thought she was tepid. And now the stock's moved up a lot, and she's not tepid, and I've been a big fan of her stuff. So we'll discuss that on the paid video, but there are real issues about the stock running up ahead of a quarter, and what do you do with Apple when it does run up? And I think I have to answer to that.
And just so everyone knows, Apple reports its quarterly earnings next week, Tuesday, July 30th. Now, our final topic today is tech earnings. We've got a huge slew of them this week.
Texas is tomorrow.
Yeah, so I want to ask you, what's the one thing that investors should keep in mind when looking at tech?
Okay, keep in mind that Huawei, which is a gigantic customer, pretty much everybody. I mean, it talks about, there are a bunch of stories this week about China investing in the U.S. and not. Huawei is, it's like the pig. It's like a teat. I mean, all the companies were selling into Huawei. So you're going to have to asterisk everything. For instance, there's a very negative piece about Marvell Tech by Goldman today. Marvell has real exposure to Huawei, but they're going to sell all that stuff to Samsung. So I think that you ought to take it with a grain of salt. When companies come out and they've missed by 3-4 cents or 5 cents and it's Huawei, don't worry about it. They'll be takers. Okay, they'll be takers of that product. Remember, you have Samsung, you have Ericsson, and Nokia. Remember, the U.S. government wants very much to make Huawei be the follower in 5G, not the leader. But Nokia and Ericsson are uniquely not up to the task, and the president and his team are starting to realize that they should get behind Samsung. Look, we like South Korea, and Samsung is South Korea.
Now, while I mentioned that Apple is next week, we do have earnings this week from Facebook, Alphabet, Amazon, and Tesla. So keep an eye on TheStreet.com and on Real Money, because I'm sure that we're going to do in-depth analysis on all of them. So, Jim, that's all the time that we have for today. Thank you so much for joining us.
We got to go to our paid video, which I think will be very good. We have the answers to some of the things we talked about.
Thanks for watching, guys. And as Jim just mentioned, we are now hopping over to our Action Alerts Plus daily rundown show over on ActionAlertsPlus.com. I'm Catherine Ross, and we'll see you tomorrow.